if you engage gold and silver again on their quarterly momentum, which we think was likely to happen in this next quarter, I think the speed at which that move occurs, the dynamics of it, will be jaw-dropping because it will not be in isolation. It will be in sync with a degradation, a cracking of the monster that they've created in the stock market and corporate debt market, in which case monetary panic will ensue. And that's what gold lives for. What we think the big issue now is for gold is this. For a dozen, now 13 years, since 2009, the Fed has done what? They've done everything they possibly can, QEs out the yin-yang, all kinds of policy moves to support asset categories that they deem to be essential. That would be the stock market, corporate debt market, primarily. And they've driven the stock market from levels. If get a chart of the S&P, go back to 2000, monthly chart. You can get them on your screen. And look at the 2000 bull market peak and then the, quote, big bear market that followed the dot-com, okay, 2002. Then you had another bull market peak at about the same level in 2007. You had another big down in 2009. And then you had this 13 years of upside. When you look at the three bull markets, the 2000 peak, the 2007 peak, and where we are now, there's no comparison. The current move is the biggest bubble in U.S. stock market history, and it's also the most protracted, 13 years. And the Fed thinks they can come in now and prick that bubble. Of course, that's not their intent. Their intent is to change policy. But if they change policy, that bubble is technically ripe to break by our metrics. And if you break that bubble, they're going to have problems like they have never seen before. 2009 will look like a joke, like the minuscule thing that it appears to be when you look at that price chart I just mentioned. When you look at that 2000, 2002 bear market, 2007 to 9, it hardly shows up on the chart compared to what we've just done on the upside and what might occur on the downside if this bubble breaks. You cannot take away the central bank impetus that's driven all these developed economy stock markets. If you take it away, you're going to have a disaster. The Fed won't admit that. Instead, they're quoting other metrics, unemployment and this, that, or the other, or to commodity prices rising. But they know in their heart and the back of their mind that they cannot allow those asset classes to turn into broken bubbles. Now, one other one I mentioned was corporate debt. There's a couple of ETFs on that. There's JNK and HYG, trade on the U.S. exchanges, of high yield corporate debt. You get good interest rates when you can't get it elsewhere, you go there. Those ETFs made new lows for the year several weeks ago. Stock market didn't, but high yield debt made new lows for the year. Now, you can't have these asset categories start to crumble. If they do, the Fed's going to have to do some schizophrenic act. They're going to have, I don't know how they're possibly going to phrase it even after what they've just done. How can they reverse what they just did? It's an academic, intellectual panic for them. And it will happen because the technicals, as we read them in these asset categories, are highly vulnerable. And they're starting to express that vulnerability. You're seeing it in the action the last week or two. Erratic, fumbling action. We think we're only a few percentage points in major indexes above starting to break this stuff. And then it's going to be interesting. So now that maybe explains why gold said, okay, you're really actually going to do it, right? That's what they said. We don't care. Cork back up again. So I think you've got to think about these things when you watch gold instead of, do this day-to-day comparison stuff. I think gold is a smart market, and it knows that if the central banks sense that they've lost their asset bubble that they created, they're going to have to do something dramatic that we've probably never seen before. Once these dominoes start to topple, this domino structure that they built, this huge bubble, beyond any bubble I've ever seen in the U.S. stock market history. And we know the policies that undergirded this thing. You can't say, it was a strong economy. Get a chart from the St. Louis Fed called Fed Funds Rate. You can download it and look at it. You don't have to print it. See 50 years of that and see where we were in 2009 on that Fed Funds Rate chart, just above zero. Never in history has it been that low. 50 years, look back. It popped back up a couple percent during that time and then back down again to the mat. We've had 13 years of rates of the cost of money defined by the state, not by market forces, but by intellectuals with power who tell us money's free. It's free in Japan, free in Europe. Okay, what does that do to reality of individuals, families, corporations, even governments, state governments that are planning budgets? When you have a major factor in your thought process, in your planning process, the cost of money priced effectively at zero, and you base decisions upon that, long duration decisions based on the assumption that the price of money will stay low or anywhere near that low, that's like building a bridge, with quicksand pillars. I mean, it cannot sustain, and therefore many errors have been committed. The errors micro errors, millions of micro errors in the economy. And when they come undone based on, it's like being given drugs for 13 years. You make a lot of bad decisions, okay? And you got to think about it. Money is the most essential commodity out there. It's the interstitching of society. It's the way human beings interact. It's not an evil thing. I don't know a gentleman in Hong Kong or in China or in Europe who may make a product that I really kind of like. And rather than patting him on the back and saying, hey, that's good, I like that, I buy it from him. And I buy it with the unit of money. It's my way of saying, thank you, I like what you just did. And if that thing I'm giving him is degrading in value so rapidly that he has to immediately go hedge it, it sort of decays social order. And they don't think about this. I think gold does. Now, on the issue of silver, we're looking for silver to agree with gold in the next upturn. I said it was a 3/4 moving average we're using as our metric. And as it happens in the case of silver, the trigger number is exactly at the 3/4 average. In case of gold, it wasn't. So as when we plot our momentum charts, we have a structure, a resistance line that stopped that last rally precisely at the 3/4 average or on the oscillator at our zero line. And we backed off again. Well, that zero line is going to adjust down in a couple weeks when the new quarter rolls around, because we're going to adjust down our new 3/4 moving average by about $1. So silver last time, which failed up there, 2534.6 was the actual peak close on that week. It failed just below the quarterly average. You get back up to about 2430 on any weekly close in the new quarter, and I'm going to break through. And at that point, silver's going to say, I'm with you, gold, let's go. And I think that's what we're looking for. We're looking for the coincidence of agreement between the two monetary metals. And I think we'll get it. And do I think we're going to get the signal? Yeah, I think we're going to get it. I think they had their litmus test here last week. All the thought about maybe. Now it's real, okay? Okay, gold should collapse then, right? It didn't. So I think the bears have had their fourth javelin throw trying to kill gold, and it just didn't work. You've got to watch the stock market most above and beyond gold. If you want to watch a market that will affect gold, watch the stock market. Now, I know there's a lot of gold bugs out there who think, because of what happened in March of 2020, when there was a very brief several-day drop in the gold miners in silver and gold, coincident with the final days of that collapse that had already been going on for a couple months in the S&P, they think, gold is correlated to stocks. And also they remember October of 2008, when the stock market had already been going down for a full year from a peak in October 2007, stock market now. In October 2008, a year after its high, gold finally said, I'm going to join in. And in a matter of 1 month, gold went from the 900s down into the high 600s, joined stocks for that 1 month, turned around and was back at its highs by the spring of the next year, 2009. Where was the S&P in 2009? Still making new lows. So yes, there was a 1 month correlation there between the sharp weakness in the stock market then and also in late March 2020. But those are about the only two linkages, if you go back through about 50 years of history of the S&P and gold, where there's a linkage, you could say, I see a linkage. Quit it. The big linkages aren't there. And right now, I think gold is digesting the distinct possibility that we're headed for a bear market in stocks, which will panic the central banks off the page because they'll have a good excuse. They have Omicron now. That's a good excuse. Okay, we'll print again because of that. The real reason is corporate debt is in trouble. And if the stock market gets into technical trouble, and I don't mean a crash, I mean just gets to a point where there's doubt and the confidence wanes quickly. We know there's a lot of very large asset managers out there who've already expressed sober skepticism about the stock market's pricing and sustainability based on variables that we're not even talking about, things that matter to them. And so we know there's a lot of major asset managers who are skeptical and are looking for alternative places to go. And a lot of them have moved into commodity-based stocks and have made good money the last year. We particularly advised buying fertilizer stocks a year ago. They've tripled. Oil stocks, yeah, they're struggling right now, but they doubled. Okay, so a lot of asset managers have already made that shift inside the stock market, but they're also looking at gold and gold related. And I think that's where you're going to see a lot of the money flow is into gold and gold related, and they're certainly cheap based on any metric you want to measure them against, especially gold miners and silver miners. So if you engage gold and silver again on their quarterly momentum, which we think was likely to happen in this next quarter, I think the speed at which that move occurs, the dynamics of it, will be jaw-dropping because it will not be in isolation. It will be in sync with a degradation, a cracking of the monster that they've created in the stock market and corporate debt market, in which case monetary panic will ensue. And that's what gold lives for.
Before we continue, help us clicking that YouTube like button and subscribe now to our channel. This shows the algorithm that you valued this information. And it helps us spread that message. Sharing is caring. And now, let's continue.
Do you want to know one thing about crypto? I made over 3000% in profit in a few weeks. Fact is, the traditional financial system, the traditional money system makes you poor, not rich. If you want to earn $500,000, $1 million, you have to wait until you're 50, 60, 70 in the traditional financial system, and you probably will still be broke. And you will be old. This is not a sexy combination, as you can imagine. But the question is, how can you start in crypto and make these profits? Where to invest? Where do you start? My name is Gunnar and I'm from Germany, as you can hear, and things are a little bit different in Germany. More about that later on. Fact is, there are lots of different cryptocurrencies. It's a gigantic universe where beginners and professionals get easily lost. But there is light at the end of the tunnel. There are 7 key steps you need to follow to become successful in this market. You have to know them, and if you fail one of them, it's literally impossible to succeed in this market. Just an example, one of the key points is your exchange, and one of the biggest are, for example, Binance and Coinbase. These are trusted and well-established exchanges, but, and this is a big but, you won't find the super profitable coins on those exchanges. The unknown super profitable coins that get gigantic profits are not traded on those kind of exchanges. They are traded on much smaller insider platforms that are barely known. And I can tell you what those super secret exchanges are and why they are so profitable. And another super important thing are the right information sources. The point is, the internet is gigantic. There are hundreds and hundreds of YouTube channels, blogs, pages, and much more. And there are also market makers and influencers. For example, Elon Musk, he is not a crypto guy, but the moment he recommended Dogecoin, it went through the roof, to the moon, so to say. But why did he recommend it? Where did he hear it from? He didn't hear it from newspapers. And believe me, he is listening to someone. But you have to know who, and you have to react before he is reacting. This is really important. And these are only 2 of the 7 steps you have to follow in order to be successful in crypto. And if you want to know all of these steps in much more detail, and if you want to have a comprehensive checklist, here's what you should do. There is a link below this video. Click on this link and you will get the opportunity to subscribe to my channel. Click on the link and you will see a video where I explain the next steps. So see you soon. Click on the link now. I'll see you there.